All right, welcome to The Explainer. Today, we're digging into a really fascinating professional investment memo. It's all about a high-stakes bet on a company called Sezzle, and it revolves around one of the most powerful forces in the market, fear.
So let's start with a really interesting question. What if you could actually profit from fear itself? Not just from a company doing well, but from the market's anxiety. And this isn't just some hypothetical question. It is the absolute core of the massive bet we're going to break down right now. Okay, so to really get this strategy, you first have to understand this kind of weird situation, this puzzle that's going on with a buy now, pay later company called Sezzle.
So, on one side of the coin, you've got this number, 67%. Just let that sink in. That's Sezzle's revenue growth year over year. In the world of tech, that is just phenomenal. That's a company that's firing on all cylinders. But that's not the whole story, not even close. And this is where things get really strange. You've got two completely different stories about the same company. On the left, you have reality. Look at this checklist. High growth, they're actually profitable by the book, that's what GAAP means. Margins are getting better, strong user base, everything you'd want. But then you look at what the market thinks, and it's a horror story. Extreme risk, volatile stock, regulators are going to crush them, short sellers are circling. It's like, how can both of these things be true at the same time?
So that brings us to the big question, right? Where is all this fear coming from? It didn't just pop up out of nowhere. Let's dig into that.
Well, the memo says it really comes down to three huge things hanging over the stock. First, this massive threat of a government crackdown. We're talking something that could literally wipe out the whole business. Second, you've got a public takedown piece from Hindenburg Research, and if you know that name, you know they're famous for sinking companies. And finally, just a good old-fashioned fear of getting crushed by bigger players.
And this timeline, man, it just lays out the whole drama. So May 2024, the fear kicks off. A big U.S. consumer watchdog proposes these brutal new rules. Then, December, boom, Hindenburg drops its report, basically pouring gasoline on the fire. The panic is maxed out. But then, check out what happens in May 2025. In a complete, stunning reversal, the government just withdraws the rules. The biggest, number one threat to this company? Poof, gone. So, disaster averted, right? You'd think everyone would relax. But this is where the story gets really interesting. Because in the markets, fear isn't just a feeling. It has a price. And for Sezzle, that price stayed sky high. And that price has a name, implied volatility. The easiest way to think about it is as the fear premium. Right? When investors are scared, they're willing to pay more for protection, for insurance. And that premium goes through the roof. The crazy thing with Sezzle was, even after the main reason to be scared was gone, that fear premium was still incredibly high. And that, right there, is the entire thesis of this investment memo. The writers are basically saying the market has made a huge mistake. It's still pricing in a disaster that's already been called off. And that mispricing, well, that's where the opportunity is.
Okay, so how do you actually play this? How do you bet on this mispriced fear and turn it into real money? Let's check out the really clever way they decided to structure this trade.
So, here's the cool part. This strategy isn't about buying the stock. Nope, it's about selling something. You're selling what's called a put option, but honestly, just think of it like selling insurance. It's simple. You pick a price you'd actually be cool with owning Sezzle at, in this case, $55. Then you find another investor who's terrified the stock will drop below that price, and you sell them an insurance contract. The best part? You get paid cash right up front for doing this. In this example, it's $9.50 a share. And if the stock just stays above your $55 price, you just keep the cash. Simple as that.
And I love this quote from the memo because it just perfectly sums up the entire logic. It's like you're selling disaster insurance for a hurricane that already fizzled out at sea. People are still lining up to buy protection from a threat that doesn't exist anymore.
Now, this is absolutely crucial to understand because you got paid that $9.50 premium up front. It acts like a giant cushion. So even if things go south and you have to buy the stock at your agreed-upon price of $55, your real cost, your break-even price, is only $45.50. The stock has to fall a long way below the price you agreed on before you're even at risk of losing a dime.
And how big is that cushion? 26.3%. That's huge. Think about it. The stock could drop by more than a quarter from where it's trading today, and you still haven't lost any money on this trade. That is what we call a serious margin of safety.
Okay, a 26% buffer is great and all, but you're probably thinking, what if the stock just completely collapses? So why are these investors so confident that won't happen? Let's get into the real meat of their argument.
Their whole case really rests on these three pillars. Number one, and this is the big one, the regulatory threat is gone. It's over. The market just hasn't fully processed it yet. Number two, the valuation is just completely out of whack. The company's performance and its stock price are telling two totally different stories. And number three, the business itself is actually better now. It's moved more towards a subscription model, which is way more reliable.
And this chart just shows you how crazy that valuation disconnect is. Sezzle is what's known as a Rule of 40 company, basically a high flyer that's growing fast and is profitable. Those kinds of companies usually trade for like 30 to 50 times their earnings. And Sezzle, it's trading at around 14 times. It's got the engine of a Ferrari, but the price tag of a used sedan. It just doesn't add up. And this is why that margin of safety is so powerful. This table shows what happens even in the bad scenario where you're forced to buy the stock at your break-even price of $45.50. Look at this. If the market just starts valuing Sezzle at a totally normal conservative multiple, say 15 times earnings, the stock should be worth $65. You'd already be up over 40%. You're basically set up to buy a great company at an incredible price, even if you're initially wrong about the stock's direction.
But of course, there's no such thing as a sure thing, right? No free lunch, especially in investing. So we have to be realistic and look at what could actually go wrong with this bet.
So what's the bear case? What keeps these investors up at night? Well, number one is a big recession. Sezzle's customers tend to be younger, with less income, so they'd be the first to get hurt in a bad economy. You could see people start to default on their payments, and that would kill Sezzle's profits. Then there's the Hindenburg Report. It's like a ghost that could keep haunting the stock and scare new investors away. And finally, this is just a complex trade to pull off perfectly.
And this table just lays it all out in plain numbers. In the best case scenario, the stock goes up, or even just goes sideways. You make your max profit, almost $1 million. But you got to look at the other side. If the stock takes a hit and drops to $40, you're looking at a $500,000 loss. And if there's a real crash, a black swan event, the losses get really big, really fast. So yeah, it's a trade that's designed to win most of the time. But if you're wrong, it's going to hurt.
And that really leaves us with the big final question, doesn't it? The question at the heart of this entire memo. When you see fear in the market, how do you know if it's a real warning sign telling you to run for the hills, or if it's an irrational panic that's creating a massive opportunity? Being able to tell the difference, well, that's pretty much one of the most valuable skills you can have in the world of investing.